All right, good afternoon. Welcome to the final talk today in the cybersecurity or the Cyber Insurance Summit here in Mandalay Bay CD. Just a reminder, if you haven't already had a chance to either today or tomorrow make a trip to our business hall on this level. The Arsenal is also in there today. And also tonight at 6:30, we have the Pony Awards in Lagoon J, K, and L. At this time, if you have not already, please put your phone on silent. And I will welcome to the stage Jeremiah Grossman, who has been taking us through the summit.
Thank you. All right, welcome back, everybody. We're going to do our third and final Cyber Insurance Summit presentation, and I'm really excited about this one. We're very fortunate to have an actual underwriter, an actual insurance carrier from a top 3 cyber insurance firm. He's going to explain to us how the sausage is made from the other side. You know, do they pay claims? How do they price risk? And all those sorts of things. And one of the things he's invited us to do here is if you have questions along the way for anything that he's presenting on, or maybe even not, you know, raise your hand and ask those questions as we go, because again, we're all here to learn. But let me describe for you just 2 things that we learned, that we're going to learn from Matt and who he is. So he's a cyber insurance underwriter, so he helps write the policies. He can write policies for companies up to $100 million. $100 million. So he has the actuarial data. We can learn a lot from him about InfoSec, about what works and what doesn't work from the data side. So I'm not going to take any more time. I really want to hear what he has to say. So please come on up, Matt. Thank you very much. Thanks.
All right, let me just read a Twitter comment that was made on Jeremiah's Twitter feed about an hour ago. Okay, so Jeremiah made a nice quote, and this is the only time I'll hold this, that basically said he's excited after kind of a long time of not having cyber insurance present at Black Hat. We finally have it, so we've got a lot to learn. Some of the comments, or the first comment within seconds was, it's a shame that another industry has to come in and big brother us into doing a lot of the things we should have done ourselves. Okay? That's not what's happening. I think it's important, as I'll go through. Cyber insurance has been around since 1999. We haven't had a significant presence at things like Black Hat, and we should have over the years. So the incentives and what I talk about, I'm going to give you some history of insurance just overall. And I know at Black Hat, there's not a ton of people who are too excited about insurance. But I also know that insurance has taught us a lot of things through history. So just by show of hands, who's into history? Okay, who's into military history? Okay, who's into insurance history? Okay, and you can probably leave. But again, really where we're focused, and on the title, how do cyber insurers view the world? We're in the same world, right? I know I'm wearing a suit. I asked Jeremiah closely, should I just wear jeans and a t-shirt? And that's not my world. But the more that our worlds interact, the more that we should be collaborating together. So just as an example, every day we're one of 700 markets, handle about 5 cyber incidents a day and at least 1 ransomware claim every day. Why that's important, right? You guys on the front lines, you guys ultimately are associating yourselves with what's wrong. We're dealing with that every day. And so we've got a lot of data to share. We made a lot of progress. And we also think that the data that cyber insurers and the volume of cyber insurance is at an exponential pace. So market estimation is about 4.2 billion of gross written premium. And I'm going to explain really the basics. But I'm also going to get into a little bit more detail about what's on the horizon and then what specifically we're focused on, which I think will help a lot of you in the room. The cyber insurance industry also has a lot to learn, right? So attending Black Hats, getting engaged, really having those conversations, cross-collaboration is what cyber insurance typically has not done. Our worlds haven't collided, and there's a couple reasons, right? We haven't interacted, we speak different languages, we dress differently, and it's easy to make fun of insurance. So we're in that same kind of cultural existence that a lot of customers have, and a lot of you face within your organizations. So I thought I'd show you a picture of our underwriting lab, right? So we're back in the, this is what we do. This is insurance. So this is actually a picture from the 1600s at Lloyd's Coffee House, where the underwriters would ultimately sign on to ships when they would make their voyages across the ocean. Now, the availability of data at the time would take almost 6 months to figure out whether or not you made money or you underwrote and took that risk on. And with a lot of the unknowns at the time, a lot of these underwriters were literally just thinking and guessing of what would occur, what would happen, based on really things that they didn't have much access to, knowledge of, or intricacies into. And again, I know I'm going back in time. Don't worry, I'll get into cybersecurity controls and specifically what we're focused for. But you got to understand, with insurance, it's been around for over 300 years. Cyber insurance has been around for 20. We got to think about this in context of the bigger picture and almost the longevity and the amount of coordination that we need to have happen. So this is wealth of nations, and I can assure you, my guess is most of you didn't think that we'd be going back on a history tour and quoting Adam Smith, nor something from 1776 would be applicable to cybersecurity or anything like this at Black Hat. So ultimately, we may learn from a very moderate profit of insurers. So there's a couple things there, right? And I've highlighted it, where most people didn't know the price of marine insurance in the 1700s. And then most actually didn't understand what the risk itself was, right? And I will get away from being philosophical, so don't worry here. And many ships, again, of all seasons, even in the time of war without insurance, would fail. So why does this become relevant? So back in the 1600s, 1700s, an underwriter knew if they made money or didn't make money if a ship disappeared, crashed, etc. And again, Jake pulled up a algorithm that wasn't very complicated. A lot of insurance and underwriting process isn't complicated either, right? Premium, losses, premium and expense. If you outpace the losses, your combined ratio, which is ultimately the profitability analysis of an insurer, less than 100% is good. More than 100% means you're losing money on your insurance decisions. And so this goes back even to wealth of nations, even to the 1600s, and really why it matters today. Okay, underwriting, right? So when it first started in marine insurance, underwriting, they understood it. The combined ratio concept wasn't that foreign, and things were going really well. Underwriters were starting to learn which ships were good, which voyages were safe, and then also, when faced with certain situations, why the protection mattered. So you can see the Union Jack flying. A lot of pirates understood that that was actually protection, and that was protection either in the form of paying off the pirates, and that protection also was in the form of making sure that those ships were protected. Okay, why that changed? So in the late 1770s, the US obviously won the Revolutionary War, and they no longer had protection. And so this goes back to the Tripoli pirates along the Barbary coast, where a lot of ships would be ransomed, and they knew that the ships didn't have protection because they weren't supported by the Union Jack. John Adams ultimately went to London recognizing that the costs of insuring ships was 20 times that it previously had, and some of the shipping came to a stop. Okay? The other element to this too is that the ransoms were too much. And why this is, obviously, there's some connection here, right? So when ransom goes up, obviously the insurance of the ship values also went up, so that without the support of the Union Jack, a lot of these insurers ultimately said, look, this risk is too much for us, and basically increased the price. This all comes together again, so things that we've learned in insurance, right? Protection is good, no protection is bad, pretty simple. Fire insurance, same analogy. Different century. So in the 1800s, industry classification started. And what underwriters realized was that the most insecure industry from fire was paper mills, which is about as obvious as it gets, right? So the insurance industry started to adjust pricing based on paper mills, and they then kind of got back to that combined ratio concept. The other aspect of this is mistakes were made, right? Good decisions were made, bad decisions were made. Underwriters that weren't paying attention ultimately were out of business. This seal, and so if you drive around on the East Coast, typically in Boston, London, Philadelphia, these fire marks existed to identify which insurer insured said buildings. And so this is the stamp almost of approval from an insurer, but it was also the way in which the fire departments could track down and at the time they weren't fire departments, it was ultimately a horse and carriage, and decide whether or not to put the fire out based on who the insurance carrier were. Okay? Cooperations. So when the Chicago fire happened, when the New York fire happened, the insurance carriers at the time realized, hey, this is problematic, right? We can't sustain this, and we actually have to find better ways to coordinate and collaborate with those that protect the buildings and the ships that we insure. The last insurance history analogy I'm going to use, so just bear with me here. Property insurance. So in today's dollars, the market in last century was only $40 million. Right? Cyber insurance market today is worth $4 billion. The loss driver last century was fire. The other perils that were insured were quake. The catastrophic exposure, was it excluded? Was it controlled? Some would say yes, some would say no, but it was controlled based on what was learned through the Chicago and New York fires at the time. The geography, San Francisco, was of concern, and the aggregation that existed specific to San Francisco was of topic and of concern to the underwriting community. What happened was obviously the San Francisco fire. 100,000 policyholders impacted, almost $4 billion of loss. The number of insurance carriers that went insolvent were over 14. The percent of insured losses paid, 76%, which is not a good statistic. And then the prior year's profits erased was 47 years. So how does cyber fit in, right? So cyber, historically, again, goes back to 1999, approximately, some would say 97, 96 before that. Back in the day where we would literally explain what cyber extortion meant and make up claims, right? Fast forward to today, and it's every day. Other perils, business interruption, cyber extortion, the ransoms themselves. Cat perils excluded or controlled. Yes, to some degree. I'm going to give a little bit of color as to what catastrophic scenarios we're focused on and what catastrophic scenarios the industry itself is focused on. And then cat events, have they happened? Some would say yes, some would say no. Not petty is obviously wake-up call. WannaCry was a signal. Not petty was a wake-up call for across the entire industry. As to the geography, that also represented a clear global issue that was specific to a specific geography that prior to that, the cyber insurance industry didn't really recognize or respect. Okay, so cyber insurance is too new to have data, and this is a real myth. Okay, so there's over 700 insurers, about 400 in the United States. Some have loss ratios that are 0%, which mean they have paid no claims or seen no claims. Some have loss ratios that are in excess of 400%. So that means for every dollar they wrote, they paid out $4. Not necessarily a sign of a good underwriter. It's pretty basic, right? It's, look, if I understand my expenses, if I understand the risk I'm taking, my combined ratio should not exceed 100%. And that's a key tenet of what underwriters do. Cyber insurance underwriters are no different. Okay, so not petty. And again, I'm happy to answer questions as they come. A lot of these companies did not have insurance. A lot of these companies specifically did not have cyber insurance. A lot of kind of commentary and some questions that the prior speakers received were really focused around, I'm reading the headlines, does cyber insurance pay? And it's really important to think about cyber insurance as a specific trigger that is specifically covered. Whereas a lot of the media picks up on property insurance where the decision maker and the insurance decision makers did not actually buy a cyber insurance policy. But you can see share of 2.2 billion loss. Since then, obviously, I think most estimates would increase that to over 10 billion. But in a $4 billion cyber insurance industry, that also results in a pretty significant combined ratio where the profits of the years would have been erased very quickly. And especially given a Ukrainian accounting software, that is actually absent and distinct from what most would consider the catastrophic systemic event that we face. So why all this is important, right? And I'm going to talk a lot about the underwriting process, how we see companies, why we look at companies, how we price this, some of the different questions that we can and cannot ask. But really, cyber insurance doesn't pay claims, and Jake talked a little bit about this, is the cyber insurance as my cybersecurity tool didn't work, so none do, right? And that's not necessarily a philosophy that we hold at all. So, cyber insurance obviously has different offshoots, number of different carriers, different strategies, different structures, different coverage. Some wouldn't even refer to cyber insurance as other insurance, right? So crime insurance exists, kidnapping, extortion insurance exists, property insurance exists, casualty insurance exists, D&O insurance coverage exists. Cyber insurance is very specific and structured to cyber risks. Now, you might also think as a practitioner or a security professional, that's great. All I care about insurance is that it pays, which in some ways I agree with you. So how cyber risk interacts with everything that we do. Again, I sat in on an IoT attack scenario, and actually where things can become physical, and we've seen a lot of malicious or damage-focused ransomware. That's also impacting other lines of insurance, which is important to understand. So it's important, right? So the last thing I would ever say is, look, security tools don't work. Some don't, some do. And that's really where we have to kind of come together and figure this out. And so I'll get into a little bit of detail as to how I think that's going to happen. The other thing, and I am going to, again, this is the only kind of Chubb-focused section, but being transparent with our claims as an industry is something that's happened in fire insurance and hull insurance for over 100 years. We have to basically share more with the communities that can actually use this data. So we put out about a year and a half ago the Chubb Cyber Index, which indexes over 10 years of our claims data, and the volume of this is obviously exponentially increasing. So how we structure it is in the VERIS framework, asset, actor, action, industry, size, et cetera, and these are real. This isn't a study, this isn't an estimate, this is real claims. We also have access to real claims dollars so that people can start to make decisions based on specifically which tools and which products that they're thinking of using, or maybe should or should not have used. Now, why this is really important, right? So setting a trend and being first is important. We're now getting most of the cyber insurance industry understanding of this, but we're also educating the cyber insurance industry and the brokers to start to speak a little bit more like this audience, right? Start to understand the acronyms, start to be able to get into a client and explain what they need to do. And we've even seen some acquisitions from large, sophisticated brokers in the cybersecurity space itself, and that's important, right? So as these worlds collide, again, this isn't Big Brother. This is basically making sure that as the cybersecurity world grows, as the cyber insurance world grows, that we actually grow both in the right form and fashion. So, no one likes bad products, right? We can all badmouth a bad product, but we can also really kind of respect and start to show some form of efficacy of the good products. And that's something that we do think will come together as both worlds collide. I do think in some ways cyber insurance was late, so we actually preceded Black Hat, but unfortunately we haven't had much of a presence over the last few years. Okay, so what's in our heads, right? And I've had a lot of conversations throughout the last day and a half. What are we thinking, right? And in some ways, I think a lot of you would think I'm actually going down a ladder to come into your head rather than up a ladder. So don't take any connotation within the slide. But we're thinking a lot, right? We are dealing with these claims every day. And we also have exposure that is existing and changing every day. And put a quote from Alex Stamos, and I apologize if I'm mispronouncing, but ultimately the struggles that you have every day are also actually exponentially our struggles. So when I go meet with a client, and again, I range from clients anywhere from Fortune 10, where I'm intimate with the CISO. We've spent 2.5 days with some clients. We've actually had a lot of time and effort spent understanding specifically where investments and spends are with large CISOs. But the reality is we also have a lot of customers that ultimately have no idea what Black Hat is, right? They don't understand what's happening. They need help. They may have the worst cybersecurity controls there are. How do you scale that, and how do you react to that? And that's a struggle that I have as a risk bearer, right? How do we ultimately sit here and say, look, we can understand our exposures, but when the CISO really has no, I'll say, formal rules around certain things, what can we do to actually improve risk overall when we don't have much visibility into that environment. And so I think where we go is obviously getting a lot more visibility, but I also want to kind of give you a sense of how big this market is. If this market was me, obviously the intimacy and the level of interaction that I have with customers is none, right? 4 billion market, I have no idea what's going on. That's not the case, right? So really just understanding the insurance, I'll refer to it as the cyber insurance supply chain, is very similar to VARs. It's very similar to security buying habits. We do typically interact with different people within organizations. So when I go meet with a large account or enterprise customer, I'm meeting the CISO, I'm meeting the risk manager, meeting the general counsel, at times the CFO. If I'm lucky, we'll get some element of a CIO. We'll get some element of again, maybe the human resources, but oftentimes it's kind of the group that's coming together for a reinsurance underwriting meeting. So what I'll kind of get into is the insurance buyer and almost the lack of coordination at an insurance buyer perspective also exacerbates some of our issues. So when you look at security tools and security products, and the reason I refer to it as a VAR, is you also have kind of the enterprise style within cybersecurity, right? I wanted to work directly with the customer and understand a lot of what's going on so that my tool is perceived as good. What I don't need is someone to broadly distribute something and then basically I'm lost in the shuffle with all the other tools and products. So you have the insurance buyer, you have a broker, and Jeff actually talked a little bit about Insurance 101, who's also has some element of knowledge around cybersecurity. A lot of the good ones actually can, I'll say, go toe-to-toe with some of the CISOs. You have the insurer. We then have a concept that's a reinsurance broker. So you have a lot of different reinsurance carriers who have kind of different styles of cyber insurance knowledge. And then you have the reinsurance brokers who also then broker what is referred to as retrocession or ILS coverage. So in the property world, a lot of these are I'll say, are almost stabilized, right? It's a mature market. A lot of the folks, they understand property insurance, or they understand whatever insurance is going up this value chain. With cyber insurance, it is new, right? With only 20 years in the books, there's an element where it's a learning curve, but because of what's changing and evolving within the cybersecurity space, it's a learning curve that has exponential impact. So it's pretty complicated when you get into, can't this be easier, right? And with 700 markets, you know, the intensity level Jake mentioned, we want to be able to raise the bar from a controls perspective. I'd say we as an industry think that we're doing that already. And I'll kind of get into how we do that. And then I'm open to questions throughout. So feel free to chime in or disagree or agree. So, and I'm going to range anywhere from Fortune 10 interactions all the way to small business where there's no questions asked, right? So typically what will happen, and again, as a buyer, you may or may not have any interest in this, or as a security practitioner, security professional, you may have zero interest and say, look, let's get to what you're focused on. But a lot of the challenge of cyber insurance at a large customer is bringing the team together. So my first signal when I walk into a meeting, and when you have the risk management team, when you have the CISO, and they've never met, I know right away that there's at least some form of lack of communication. Now, then you also have some customers who literally you can tell they've gone through things before. That's also could be perceived as a negative. But a lot of these different observations and experiences, they tend to be cultural. And then we also focus on structure of the organization along with spend. So if we can kind of determine, and I'm just broadly setting an expectation where the cybersecurity spend is less than 9%, or as an example, if the financial institution industry and the security spend is 6%, 7%, I automatically know there's at least some form of imbalance, and my goal is to find out why, right? So that's a kind of an easy, well, I should say, that's somewhat of a concept that as an underwriter, you kind of learn over time. You then have kind of just knowing what a company does. And so that seems very basic, but really a lot of these underwriting meetings are focused on, look, what do you do? And I might actually be able to explain to you where your cyber risk is. Now, there's obviously kind of the consulting industry that can also do similar things, and they do it well, but they're also not looking at it from an insurance recovery standpoint. So a lot of our interactions with customers is on that very basis, right? What do you do, and what are the bad things that could happen as a result of that, especially in a, not just data breach, but just a system interruption, something similar to NotPetya is how bad could things be? And so that's a really key part of the underwriting methodology. Security, and we're going to get into more detail on security and privacy. Just as an example, and again, the established markets, you can range anywhere from, 347 different factors on an individual risk, regardless of size, that an underwriter could basically say, this is good, this is bad. And I use 347 because that's part of the filing process. So we actually have to evidence, and this is a US-centric comment, we have to evidence why we're asking certain questions and then the perceived risk reduction that we think. And that's a challenge for cyber insurance. But what we do expect is an underwriter to go through that methodology and that process. Now, if that underwriter is a human, that obviously is time consuming. If that underwriter is dealing with a small risk or SME, then that underwriting intensity obviously goes with the other 500 markets that are looking at that same risk. If that underwriting intensity is at the, again, I think referenced the up to $100 million in limit, then we're spending days going through this and making sure that we're making the right decisions. Some of the basics, right? Governance, technology team governance, technology team spend, the staff themselves. So most customers, again, large enterprise customers, we will look at backgrounds of a lot of the folks on the team, but we'll also look at where they're spending money on specifically where we think they need to be. And I'll get into a little bit of that. But, we're seeing obviously identity access management. I can't tell you the number of customers where I've gone to where we ask them, where are you focusing your spend? That typically is this year's answer. And then the question of why or where or how comes with it as a result. And then really learning from that can also help us influence the smaller customers. So there's customers that ultimately may not have a CISO, they may not even have a security team. We actually can start to add value by saying, look, here's what we're seeing, here's what we're focused on. And the last thing I would say is we don't need to tell a large Fortune 500 CISO that user awareness training is a good thing, right? If that's our only question and our only kind of value that we add back, it's no value, right? We really are starting to educate even those Fortune 500 CISOs on things that we've experienced or things that we've seen, and not replacing threat intel, but just explaining, okay, this is something that's occurred, and really where does your risk management team want this from a risk tolerance level? Let me start with claims activity. So just general observations. A company that's gone through a data incident is a better company as a result. Now, there's some elements there where obviously there's caveats, right? They've gone through a ransomware event and they ended up paying and made the decision to pay. There's some concerns, right? So the various, especially as it relates to the compromise or the indicator, wherever it happened, there's things that you can fix. But the reality is most of the time a company that's gone through this is actually a better risk because the company broadly has gone through this. And again, the experience that we bring is a lot of that, is explaining why that's important so that it's very obvious. That's because your experience on this event and you've had the chance to make sure that the urgency is important and the decisions are pre-vetted. The security presentation, and I do think it's really important as the cyber insurance market, as we collaborate more, right? So that collaborating more is an absolute must with this community. But we'll focus everywhere from vision, right? That's an easy one. Hi CISO, can you give me a sense of where you see this, where your company sees this, where your company has certain cultural, I'll say, reservations about certain things? So just recently, with some of the ransom payments that made their way into the media, has your company actually sat down with the decision makers and come to the conclusion that you will or will not pay? And that's obviously an extremely complex conversation that when you're explaining that to a CEO at the time of incident is a really bad one, right? Or if you're doing it through the underwriting presentation, if I'm asking that question, I have the ability to influence that customer and say, look, this is something that you've got to sit down and do. Again, Fortune 500 CISOs, we get it. At the same time, the rest of the world hasn't had that conversation. So there's elements there where the culture of the organization and the culture of the security team within the organization can tell us a lot. So if I think that the security team doesn't want to have that conversation with senior management in advance, that's a sign. That's a bad signal. Again, strategic initiatives, I focus on that. I mean, it can go across the organization. Where are you focused on your spend and why? And where are the timeframes in which you're going to implement? And then where are the barriers to implement, said improvements? I can't tell you a number of times information governance, again, becoming more of a, refer to it as just one of the other cliches in the cybersecurity space. It's not that complicated. What data do you have? Where is it? And how do you protect it? Small customers, big customers, even mid-sized customers, the simplicity of that is not that complicated. And when we talk to a risk manager, if we talk to the CISO, if the team has a CISO, most of the time when it's outsourced, that question at a simplistic level, as simplistic as it can get, is a struggle to answer. What data do you have? Where is it? How is it protected? Right? Kind of basic, especially for this audience. The plans. So IR planning, DR planning, BCP planning, that's things that we'll review at times, and then that's things that we just expect are in place. So there's a different variation there. Security awareness training, mentioned it, right? So we are starting to just assume, and I don't mean that literally, but any large customer that hasn't recognized that security awareness training at least does something, there is at least some element of ROI there, that's likely a customer that will ultimately be paying more and should be paying more if that basic isn't covered. And so I'd say the same for multi-factor. I'd say the same for offline, online backups, the different RTOs, all the fun, really all the fun network security things to talk about, where if they're not answering those sort of questions the right way, then the return on investment as you go up the technology chain goes away. And that's really important, I think, to this community is if we're focused on something, that does mean there's an element of basic or at least expected with whatever customer that we're talking to. It's broad generalization. It's obviously a very biased perspective on the cyber insurance market overall. But really, if we're not asking a question that we don't know what the answer should be, then we shouldn't be answering the question. That's insurance underwriting basics. And that's something that as CISOs, if you are CISOs, or if you are getting a question that doesn't seem right, you should be inquisitive and ask said underwriter, that's great, why are you asking that question? Because cyber insurance is new. We even joke sometimes we should just ask fake questions and see if the market actually goes that direction. We wouldn't do that. It's probably not in the best interest of the market overall, but that's the reality of where we're in today. Again, active defense, threat intelligence, things that are what a lot of folks here is obvious, but that's also part of the conversation. Now, privacy. And so obviously the security versus privacy issue with GDPR, with CCPA, with China cybersecurity law, I've run the gamut, BIPA, Illinois biometrics. This is also cyber insurance. Now, most of you in the room would think, oh, why is this cyber insurance? But cyber insurance almost started as privacy insurance. So as cybersecurity controls go up, as the regulation and the enforcement goes up, we're also trying to balance that from a pricing perspective. And I will get into pricing and actuarial methodology and all that fun stuff. But that's also something that's changing exponentially almost every day, inclusive of enforcement, inclusive of values of enforcement. Okay, and I'm hoping most of you saw the Netflix documentary on The Price is Right, where the guy memorized every single price of every single product on The Price is Right, but unfortunately he still lost, right? So I have this in, again, pricing is an important topic, but it's also a topic that's had 20 years of experience, and it's going to have about 200 years of analysis, right? So one of the other challenges with insurance is that the pricing, especially in a liability setting, we don't know the true cost until maybe 6 to 7 years after, So when you read the headlines as to profitability, there's also a lot of different components within that you have to just recognize. And when you see some carriers have 0% loss ratio, whereas others are over 400%, you're starting to see some strategy at least arise that is informing a little bit better risk posture. And that's something that is a challenge as the market continues to grow in numbers. Okay, so aggregation. So again, how we price. I mentioned the 347 different factors. A lot of markets focus on revenues. Some focus on total assets. Some will focus on endpoints. Some will focus on employee count. But that's good because if one of those is indicative of the correct pricing, the insurance industry has a tendency to solve for that as we gather more data. Now, I mentioned the cyber index. That's also important as we correlate and cross-correlate some of the different events that we're seeing to the actual data with a lot more data as we pull in and start to work a lot more with technology providers such as yourselves. So aggregation, okay? This is a topic, and this is a key topic for cyber insurers as it stands today, and it has to be a topic, right? So as not petty as the example, a lot of insurance regulators want to make sure that insurance providers can pay the claims and the promises that they've made. Pretty basic, right? When we deal with a tornado, when we deal with a hurricane, we do have a tendency to know our aggregation. Now, a lot of those tools that even exist, they haven't been around for that long. CAT modeling tools in the property space have been around at most 40 years. And so that seems somewhat surprising, but it's also showing somewhat of an element of the data usage and the ability to model is being driven so much by data and the availability of data. So go back to kind of the Lloyd's Coffee House. They weren't learning about things until 6 months just because phones didn't exist, which is somewhat obvious. Now we're starting to focus, and the regulatory industry is focusing on how are you underwriting these risks? What's your strategy? Does it make sense? But they want to see that there's formula and strategy around each and every single account, but also at a portfolio level as well. And as an example, do you have the claims capability to pay for these events? And do you have the bandwidth to handle some of the big systemic events? So that's a focus of regulators. That should be your focus as you think about cyber insurance. Is, again, Jake mentioned a couple different service providers. If they were to go down, even though it's outside your environment, what does that mean for you as a security professional? And it typically will mean something impactful. And so you'll typically need an incident response process that addresses that. And then once you recognize that the entirety of that entire space is tied up with the same event, then where are you focused? And so the cyber insurance industry is starting to do a lot more work associating that with the systemic event and making sure that the incident response processes of all the customers, there's bandwidth for that. Just a basic, and this may be too coverage heavy, so I want to leave a good amount of time for questions. But silent cyber is also a topic. And what silent cyber means is ultimately insurance products that existed prior to cyber insurance that ultimately either affirmatively covered cyber risk, or if it's silent, there's no clarity or there is ambiguity as it relates to if a cyber triggered event triggers that product. And so that sounds, again, to those outside the insurance industry, way too complicated, but it is an extremely big topic in the insurance industry today. And for a variety of different reasons, right? So clarity of coverage, customers want to know what they're buying and which products, but they also want to understand how cyber risk influences and impacts those products. Customers also want to understand how certain cyber risks are impacting their traditional way of thinking, right? So with the IoT device, just the obvious, right? I don't need to tell this crowd with the exponential increase in dependency, but that's a problem. Right? So as we look at some of the scenarios that we model for, and again, this ranges anywhere from distributed denial of service on a certain industry or broad industry. This is DNS attacks. Again, there's examples of this actually happening where we will backcast and look at how that would impact our portfolio. There's also technology startups that are focused solely on getting at cyber aggregation, which is really important. Again, I mentioned, CAT modeling. This is not a tried and true thing, even in the property space. So Hurricane Andrew, which is only 25 years ago, was a moment in the insurance industry that ultimately said, wow, we don't have a sense of our aggregation. We need to solve for this. So when we now, again, 25 years later, using data, using analytics, using modeling, we now, collectively as the insurance industry, feel that we have a better sense prior to something like that. The reality is there's certain things that have occurred that weren't contemplated. Again, wildfires is the other example where is that modeled correctly, or is that a non-modeled exposure? So really, the cyber insurance market, and even the regulators within the insurance industry, have actually learned a lot from prior products, especially when it comes to aggregation, but we have so much more to go when it comes to the specific threats and the specific technologies that could expose large, vast portfolios. And so, again, I'm focused on a lot of different things, and there isn't one idea that's too wild, right? We actually have a team that is focused specifically on what are the emerging risks. They have security background, they've got underwriting background, and we're also collaborating throughout the industry with what's next, right? So we want to know what everyone thinks is the obvious systemic event. One example, and I'll go back to NotPetya, when we're meeting with large customers, right? And when we sit down and when we learn from past events, and I'll reference WannaCry, and there was a pretty short time period in between, we sat down and we wanted to understand how companies were impacted by that, but we also sat down and wanted to make sure that we're thinking about these things the right way. There's not one individual, and again, unless there could be caveats in the audience, but there wasn't one individual that said, you should be asking your clients for, are you using backdoor tax accounting software in the Ukraine? Now, if I asked that question prior to it happening, I'd probably be arrested within minutes the next day. That's not what anyone was focused on. That's something that as the cyber insurance industry starts to look at modeling and starts to look at systemic aggregation, where are the common applications, where are the common service providers, and where are the dependencies that we can get our hands on? And that's really starting to happen. So we look at, again, using a few different tools, threat intel that a lot of you offer, or at least use in the room. What do the bad actors want to do? Who is it? And then what's their accessibility to that? And then we look through the kill chain analysis and a variety of different things. But we then take our portfolio with the concepts that we learned in property insurance and fire insurance and even marine back in the 1700s and apply that methodology to ensure that we are actually getting paid adequately for that catastrophic systemic risk. It is still an outstanding item, which obviously as the different threats change, as the vulnerabilities change exponentially, and I sat through a couple unsettling, unnerving sessions already today, this stuff is changing. And so it's really important that catastrophe modeling is part of the cyber insurance community. And with 700 different insurers, that's a pretty big undertaking. So it's important to think, look, this is, again, cyber is new in relative terms. But some of the things we're learning can also inform some of the products you guys are making. So let me I'll talk a little bit about kind of the evolution and where we've kind of come, right? So 20 years ago, it was ultimately focused on enterprises. Now there's more focus on strategies that are becoming either successful or unsuccessful, right? If I'm a market who thinks that I should write all business in the Ukraine, then I'm probably not doing business anymore in cyber insurance. If we have tools that can start to show us the aggregation, if we have tools that can give us a little bit more account-specific visibility, which we do collectively have an insurance market, that can also start to inform a little bit better decisions when it comes to how we interact with clients. We also are at the point of basically making sure that anything that we can offer is digestible to the broader community. So as an example, an enterprise customer, if we're asking, what are the security companies that you're looking at, your third parties, we know the list. So does the CISO at a Fortune 500, but also what can we offer to some of our smaller clients that can inform them a little bit better. And that's why we do think that there's a need for more interaction, and there's more interaction happening almost with every market and every security provider as we go year to year to year. So that's a good thing. More insights into the events themselves. Us sharing claims data can help a lot of different people, right? Just being able to relate to and then just raise awareness over what's actually happening versus what everyone reads in the media, in the headlines. And that's important. Within our company, we actually have a team that will look through all the threat, the threat intel, all the media reports, and either validate or invalidate some of the misnomers. That's really important so that we don't start to overreact to certain things and underreact to others, which is also very much what a cybersecurity professional does. What do you need to be aware of versus what's more like noise? And you can see it even in the some of the advertising that I'm seeing in the at the conference. The attritional losses. So ultimately telling customers what ransomware is, to the Fortune 10, Fortune 100, don't need it. To the small business, this is like a new thing. And that's part of the problem, where we have a lot of data to support kind of the offline RTOs and the importance of online backups, whereas this is the first time they're hearing these things, which is a sign that we collectively, and I say this, with sincerity, we're not getting out enough into those kind of more SME, really just the education levels aren't there. That goes across really society in general. Culturally, we don't get cybersecurity, which is a problem. The insurance community is starting to at least go up a different channel, or basically showing how important some of the things that this audience does from a cybersecurity perspective. Now, hearing it from a risk manager and an insurance decision maker might influence some of the buying behaviors, and that's really what needs to happen. Education. So just as an example, educating our own agents and brokers, aside from educating our own underwriters, is really, really key to be able to sell cyber insurance, but it's also key to analyze companies and make sure that you understand exactly what you're underwriting. Just as an example, to show a little bit of that correlation, we worked with Carnegie Mellon, launched an actual certification course on what cyber insurance is, and they've been very present, obviously, in the CISO community doing the same thing, even in the chief risk officer community as well. So almost just cross-pollinating that audience, just as one carrier as an example, is really just an example of what really could be on the horizon. The underwriting, or the claims process. So this is an area that understanding that we have over 10 people dealing with cyber insurance claims, and we're seeing over 4 to 5 a day, is really important, right? So when we talk to our claims team, this is not your traditional claims adjuster that you see in some of the advertisements on TV. These folks are dialed in on ultimately everything from SAMSAM, which we haven't seen obviously since late 2018, to Ryu, to all the different variants of malware, and they know specifically, again, the importance of cyber insurance is knowing who to call. Jake alluded to that. But it's also knowing the tendencies of whichever bad actor that we are interacting with. Again, I use the term we loosely, really the cyber insurance market overall, but how much more valuable that is to the end policyholder or the insured themselves. And again, learning from past events is what we've done in insurance history. And if any underwriter says, look, I didn't really learn from WannaCry, I didn't learn from NotPetya, then they shouldn't be underwriting cyber insurance. So there's an element there where it's important as we kind of cross-pollinate that this audience starts to understand that this cyber insurance thing, again, it's a $4 billion industry. There's different variants of different cyber insurance that you really have to keep in mind, and it's really important that you understand. I've got about 2.5 or 3 minutes for questions if there's questions. Yeah.
So a lot of what you talked about here, it sounds a lot like focus very much on traditional data center like things from NetPetya, ransomware, etc. I'm wondering, where does cyber security insurance come into play and crossover with more traditional insurance when we start talking about interconnected devices? I'm thinking here specifically about cars that have multiple computers in them, airplanes, etc.
So I'm going to repeat the question. I'm going to kind of maybe shorten it up a little bit. But with the advent of IoT, connected cars, airplanes, obviously from a software perspective, how does cyber insurance view that? Cyber insurance underwriters are dialed in specifically to that. And then from a coverage perspective, understanding the nuances of coverage and kind of the coordination of coverage across different products. It's where property and casualty and some of the different kind of more traditional products either explicitly do cover or explicitly don't cover. That's a big topic within the insurance industry. So the eyes wide open awareness of how that's happening, I'd say generally cyber insurance underwriters get that. I'd say more specifically, the broader underwriter of more traditional lines may not get the significance of that in their products, which really gets at the silent cyber concern from a lot of the regulators, where regulators want to make sure that the underwriting community understands cyber risk. The problem that we have, which I think is also a problem that you have, is that the cybersecurity insurance underwriter community still is small, and the education level is going up, and the broader underwriting community, again, a property underwriter, there are some very good property underwriters that understand cyber risk. There are also some very bad property underwriters that don't understand cyber risk. And then there's also good property underwriters that don't need to understand cyber risk just yet. So there's a lot on the horizon. And I'm hoping I answered the specificity. If you want to go into more like coverage interaction, there's a lot of different products that either launched in the last 4 or 5 years that actually will coordinate that coverage for you so that it's at the advantage of a customer. And that actually could go off on a tangent that I'd be happy to get into more detail. Yeah. So cyber hygiene score. So several different tools. I'll range anywhere from security scorecard to BitSight to a lot of different others. I apologize if I'm missing a few. But that ultimately gives an underwriter an outside-in perspective. It can tell us something. And again, I'm saying us as in the cyber insurance community. But it also gives you elements of that's the short version of really what could be useful data, useful information in the long term. It could also be useful information in the short term that either is validated or invalidated by claims. So a score, again, some markets will use their own score, some won't. It's really important that whatever that hygiene score, it actually goes to that profit margin so that everyone understands why that hygiene, again, I'm using cyber hygiene score because you used the term, but that's important. So if there is a accurate cyber hygiene score that's predictable and relating back to claims and loss ratio, then any underwriter that has that should be sharing whatever elements there are that are important. I think the challenge right now is some of those scoring tools and technologies, they can help and they can add some element of margin, but there isn't that one, solve all product, much like a lot of the tools and products that we all deal with, is if you have a product, the cyber insurance industry wants to know about it. And I mean that sincerely, we're all afraid that we're going to miss the next product or tool that ultimately does stop incidents. Yeah. Yeah, so the question is, how do we incorporate Chubb's own CISO into our underwriting process? I couldn't have made up a better question, but I'm glad to answer that. So we actually hired on our former global security architect to be part of the underwriting / risk engineering team. And then we also, again, anytime that we're faced from an executive management perspective, we want to make sure we're gut checking things the right way so that we're using all available methods of data that we have at our disposal. Interacting with our CISO itself is paramount, right? If I'm thinking something and it's actually either invalidated or validated by someone else, that's a good thing. It's why these communities need to kind of more, come together and just, if you're thinking something, especially, I'll gut check with some of our forensics providers almost every day. What are you seeing? Am I thinking about this the right way? And for the most part, even though we think we are, there might be something that we're missing. So I guess to directly answer your question, I'm not going to give you details as to the cadence, but on a fairly regular basis. I think this is going to be the last question because I'm over.
Okay, yeah. I'll try to make it quick. So going back to your presentation on pirates, modern day pirate, the lawyer. We have the California Consumer Privacy Act coming up, and it increases the statutory damages for data breaches from $100 to $750 per person per incident. So are the carriers worried that this is going to cause an increase in the number of data breach class actions filed and corresponding increase in the amount of claims being brought? And is there any anticipation that carriers are going to be auditing policyholders to see if the things that they say that they're doing, they're actually doing?
Yeah, so the question was ultimately associated with CCPA and I'm going to generalize, which and also ultimately looking at enforcement and the expectations that CCPA brings with it. And any underwriter will tell you it's of topic, it's of concern. If enforcement actions change, and GDPR, I would apply it the same way. I would apply it to the Russian data security law. I would apply it to the China cybersecurity rule. All of those things are things that we look at from an enforcement perspective. With some of the fines and penalties that we've seen, and again, I think we've all seen in the media, it's ultimately a question of, okay, how does this change my underwriting and what's next on the horizon? Again, the emerging risks aren't just technology. The emerging risks oftentimes are actually the litigation, the regulation, the enforcement of that regulation. So it's a concern. Now, do I think that the underwriting community is underwriting specifically to certain elements of CCPA? I'd say it runs the gamut, right? So with 700 insurers, some might not care. If you're focused on a large enterprise customer with a significant limit, that's definitely going to be of topic, and it needs to be. And for the most part, that bar, we're also serving to kind of educate the lower, I'll say scale or SME customers on. This is a regulation that you absolutely need to understand and know about. And for the most part, they, at this point, unfortunately, don't. And that's where the insurance community actually can bring that up, which we've done in other kind of lines of insurance. All right. Thanks for your time, and enjoy Black Hat.